go. Mic check, mic check. 1 2 1 2. Good morning. Great morning, everyone. Hope you're well and doing great. Trying to pull myself into it, and then we are live. CTM. Good morning, good afternoon, good evening, wherever you are in the world today. I am so glad to be here with you as we get ready for today's Thursday session. By the way, Jose, thanks for the reminder. Let me take down that counter over there. Thanks for the reminder. Tomorrow there'll be no live stream. Traveling back home to Mexico. We'll pick it back up on Tuesday. We're traveling again on Monday. So Friday and Monday, no live streams. And then Tuesday and going forward, we're back to our normal schedule. And I enjoyed a lot. I really loved all the comments that were shared on yesterday's video regarding our flow here, how we like to go ahead and do the live streams together. It's a format that I really personally appreciate. And I also really liked all the comments and thoughts shared by everyone. It really helps me connect with all of you. And I like that a lot. We're looking at this morning, equity markets off the back foot, right? We're seeing jobless claims coming in way better than expected to a 5-month low. The expectations were 213,000. They came in at 193,000. And that does give Jerome and company more room, presumably, to keep on tightening. And it looks like that they're intent on tightening regardless of what it causes or the reverberations cause out across the world. They're worried about domestic policy right now, or so they say, and that other central banks will have to go ahead and, I guess, act accordingly. We saw the Bank of England do that just the other day. We also had an unexpected surprise. We had the reversion of the second quarter GDP, and it showed that unexpectedly that hot personal consumption was very strong. In other words, the U.S. consumer continues to consume. So we continue to have signs that the economy continues to run hot. Do you remember when the Fed told us that they believe that the economy could withstand the tightening? So far, they are correct. And I imagine they'll be correct until they're not, until something actually does break. But right now, we continue humming along. Tomorrow is the last and final print for Atlanta Fed's third quarter GDP expectations. You have to wonder if it's a negative print, whether or not they will continue to say that we're not in a recession. I mean, 2 consecutive quarters of negative GDP print. I mean, they said that we're not yet in recession. I think that I was one of the few at the time that was like, well, since I've been involved in the market 24, 27 years, it was never that black and white. And, you know, I certainly don't support this administration or any administration, so I'm not supporting them. I just don't think it's that easy. I think it's very nuanced, and we are seeing, and when I look around, I ask everyone that I see, are you seeing any signs of slowdown? Are you seeing any type of recessionary pressures? And there's not one person that I've run into that have seen anything like that. So I'm not so sure. And but tomorrow, if the expectations come in that we're looking at 3 consecutive negative GDP prints, I mean, are you going to call that a hard landing even? I mean, come on, that's talk about slowing growth. It's come to a standstill. But we'll talk about that more tomorrow as we get a little bit more information on that. I want to start off today's session with some thoughts over here. It's about a minute and a half from Stanley, the Druckenmiller. Let me start there.
I will be stunned if we don't have a recession in 23. Don't know the timing, but certainly by the end of 23. I will not be surprised if it's not larger than the so-called average garden variety. And I don't rule out, not my forecast, but I don't rule out something really bad. Why? Because if you look at the liquidity situation that has driven this, we're going to go from all this QE to QT. We're following an asset bubble. We've been doing all this running down on the SPR, which is now, that's the Strategic Petroleum Reserve. It's now below 84 levels, even though obviously oil consumption is much higher. We've had a bunch of myopic policies that have actually delayed the liquidity shrinkage. QT has been almost entirely offset by Janet Yellen running down the Treasury savings account. By the way, pretty amazing policy. She could have sold 10 years for under 1% during this time. Instead, she runs down the Treasury savings account. So all that has masked the liquidity shrinkage, but it really comes into full gear. And she can continue this for a while. We could do the SPR for a while, stimulative stuff, but by the first quarter of 23, it kind of goes the other way. So our central case is a hard landing by the end of 23, but I don't know. I've been wrong on a lot of things. I could be wrong on this, but since I do it for a living, that's our forecast, which is a recession in 23.
All right, so a couple of things to bring up over here. And first, everyone who's been following CTM for quite a while, they are or understand that I've been a fan of Stanley Druckenmiller for quite a while. And I continue to be, there's no question about that. Stan has taught me many great things. Among them is that what he learned, the most important lesson that he learned from George Soros, and that was when you are really clear about a trade, you go in very, very big. I have the utmost respect for Stan. There's no question about that. There are some things in that little clip that I really did not necessarily agree with. By the way, it is interesting that Stanley, the legend, is saying or looking for a recession to come into 2023. Notice that he's not saying we just had 2 consecutive quarters of negative GDP growth. We're in recession now. There was quite a bit of controversy across crypto Twitter, across all of the macro analysts when we talked about, well, I really don't think that we're in a recession. A lot of them thought or adamant that we're in a recession. A lot of them referring to Stanley Druckenmiller just yesterday and talking about how in 2023 we're looking for a recession. But I think that's pretty much the base case for everyone. And if we look at the dot plots, we know that we start seeing into 2024, the rate cuts starting to come down. That's indicative of easing because we are looking at a slowing economy. I think everyone is looking for a recession in 2023. I don't really think that's a big deal. Regarding the quantitative tightening being a little subdued by the Treasury's added liquidity, something that through Zero Hedge we've been able to look at ourselves, only I think that quantitative tightening doesn't get geared up until right now, the end of this next week, is because you've seen the way that they're doing quantitative tightenings, they're not actually selling any type of securities. They're just waiting for them and not rolling them over. They're letting them run off the balance sheet. So the Fed really had no control over that. I don't think it was being negated by the Treasury sellings. I think that maybe that was a little bit trying to find reasons to why 2023 would be bad. Again, I love Stanley. Everyone knows that. I have been the biggest supporter for many years publicly of my admiration for him. I'm just not sure that everything there lines up correctly. And I'm also wondering, why has Stan the man been doing a lot of public appearances? It's very far and few between in the past. And I saw recently him joining the I probably pronounce it wrong, the Plantar team, giving that nice speech, talking about his thoughts on the economy. Here he is again on CNBC. I don't know. Something's going on either which way. I'm looking here right now today at the reverse repo chart, and we are looking at $2.7 trillion being, sorry, $2.3 trillion being parked overnight. There's a massive amount of liquidity over here on the sidelines. It has nowhere to go. So it's being parked overnight to collect yield paid by the Federal Reserve. I forget, we've shared the numbers before, the obscene amount of money they are paying daily in interest. I don't know. This could evaporate rather quickly if we saw some type of systematic shock. If, for example, I don't know, if Apple went under and all of a sudden its bonds became junk, I think that we could see this evaporate really quick. But why it's so high, I think that there's and I've talked about this back when we were looking at, let's say, I think it was the spring of 2022 here, when a lot of people were really looking for something to break. And I don't know, I think there's a lot of liquidity out there. I pointed to this chart. Since then, we've seen Arthur Hayes also point to this chart and talk about the amount of liquidity out of there. You know, during QT last time, you saw this disappear. When QT started, this disappeared. And then this led to actually something breaking. Anyway, Fed terminal rate expectations began dropping yesterday on Bank of England's quantitative tightening pivot. And then you also saw in unison rate cut expectations actually jump up a little bit, meaning there's less of an expectation of rate cuts coming sooner than later. I think, and I've thought this so far, that this may go on a lot longer than people expect. They're masters at extending the cycle. It does seem that we keep chugging along, that right now things continue to run hot. While we are seeing literally things break, it's across the seas, and we're going to, I think, continue going. Now, that's only one view, right? I was talking about yesterday trying to hand out or get in front of us all different views, talking about Luke Roman saying that he thinks that this last hike that we saw last week will be the last hike of the cycle, and that the Fed won't be able to cut into November. There's a lot of time right now. Several weeks is a lot of time right now in the markets. So we will see. And even though those even though those are his views right now, you have to allow him over the next 7 weeks to adjust as well. Literally, we are data dependent and we are in unprecedented times. It's not so easy. You can't get caught up in one way or the other. We were looking at yesterday's dollar coming. Let me get into some charts over here. We're seeing right now the dollar falling back off. That's interesting. Let's take a look at it. I want to start on the 1 hour chart just to show you over here as the markets closed over here for 1 hour. When they open up again, there was a massive gap up. I wasn't sure what caused that. I'm still not sure what caused that. And then you could see the markets actually rose, and they rose into what? They came above that line of broken support we have as resistance, right? So let's see, is it worth or warranted? Do you see over here where the market was finding support and then it found resistance over there? I just wonder. I'm just going to clone that up there and then bring it down to where that low is over there. And I guess that's what's happening. And the thing about those clone trend lines is that makes the market structure throughout. You could have a gazillion of them if you keep cloning them. Nevertheless, is it fair to say that the market was able to find support over here, right? And that it found resistance over here, and that this line over here right now is probably taking a little bit precedence over the one below it, but they're both still, in fact, important? I think so. Rejection over here in this area, not so easy, not so fluid, coming back down now. That's interesting. You would expect the dollar to be a little bit stronger on this morning's jobless claims. I'm wondering why indeed, or in fact, it is now closing that little gap, right? Not that that's important. I'm just making an observation. And then let's see what happens next. I noticed today why the equity markets were coming off, that we were seeing Bitcoin hanging in there. Bitcoin continues to go sideways. Bitcoin is going sideways or ever since the June low. I don't know. It might be a little bit concerning. Does that remind you of anything? When was the last time you saw Bitcoin go sideways for an extended period of time? It has flashbacks of 2018 vibes. You all remember what happened in 2018. And if you don't, we were going sideways for an extended period of time. And everyone over here, well, okay, as long as 6,000 holds, it's going to be okay. And there's a good chance that we're going to be able to hold here and break out. And then you had everyone else looking at it and being like, well, generally, when you have a flat line like that, it's only a matter of time before it breaks. We saw a 50% fall off of that $6,000 line in the sand. And, you got to be ready for everything at all times, especially psychological. The longer this continues to consolidate over here and just go sideways, the more concerned I would be that we are getting ready for a breakdown. If we do break down, I would not be, by the way, any type of deterministic about, well, that's the last move down and from here we go straight up. You know what? Everything right now depends on the macro. There are some Bitcoiners who don't like to talk about that. They're actually saying, I can't believe that we are talking about instead of just like the network itself that we're talking about the macro. Well, guess what? Bitcoin has grown up and it is the primarily affected by the macro. We've seen that now for not even just a few years. I mean, this thing bottomed in 2018 because of the macro, right? Anyway, we've looked at that before. We're not going to look at that today. We're going to keep going though and look across markets. Let's start with the equity markets today, and this is a little dicey. I'm on the 1 hour on purpose to show you. Like, this is our normal view over here. I want to show you what happened overnight because it looked like that we had a breakout. Well, we did have a break of this trend line. All right, we had the break of this yellow trend line, but what was our analysis? Right? Well, we had a confluence of resistance above us. The confluence of resistance included three things. It including, first of all, this horizontal trend line, this line of resistance. Broken support is now resistance and continues to be resistance. And then we had the trend line. So trend line break into resistance. That's not a good thing. We have this overhead resistance, but I expect a break of this trend line resistance to bring us into the upper resistance, only it's got to first get above the horizontal resistance. That right there provides a pretty good line in the sand, depending on how far we go over here lower. You can see that we're also fighting. We're into local support. There's a lot of indecisiveness going on, and that could work one of two ways. Now, the things about bottoms is often they're very hard. I don't even want to say that word bottom. I think that a lot of people could get very, let's just say, triggered by it. And the dicey is a really good word over there. It is very dicey. That's the best way to describe it over here. We are on the verge of breaking down and taking out this week's low. We're being rejected by resistance over here. Pretty neat to see that once rejected by the resistance, what did you see over here? You saw the trend line holding. This is on a 1 hour time frame, but you could get a really keen view of the market structure. The resistance holding, and then once it breaks below the trend line, do you see the two touches into the trend line as resistance now? So we got resistance, right? Extended out further. I don't know how much further we need to. And a break above there, it still has us very, very cautious with the overhead resistance, right? Until we get right now above this line of resistance. Right now, we are below every bit of resistance with a negative bias, and you can see the equity markets currently trading off. We know where that flips, and it hasn't flipped yet. S&P 500, I imagine, is close to the same thing. It's almost identical. So I don't have to give any type. It's the same analysis we just looked at on the NASDAQ, right? So I didn't get a chance yesterday to take up the topic about my thoughts on the real estate market, and I got to read everyone's comments yesterday. I really enjoy that. There were a lot of them on yesterday's video. I feel like it's like a really good opportunity to get to interact with all of you. And one of the comments was that sometimes they like when we do like the question and answer type sessions, and yesterday's question on the real estate, I really meant to get into. I meant to talk about. First of all, I don't know. I'm going to frame it very easily, right? Obviously, we are seeing a lot of people wish that they sold the top. And what they're trying to do is get their house on the market because they had plans to sell. They loved the equity they built up in their property. And for whatever reason, that they wanted to get out. Now, where are they going to go? That's a different question. And that question now becomes a lot harder, as for them to go ahead and move, they have to get a new mortgage, and that mortgage is now vastly more expensive than their previous mortgage. That puts a lot of people, I think, on standstill, meaning the people that have their houses on the market are going to have a difficult time finding buyers. Now, if we do see a deteriorating economy into 2023. And by the way, that's not a given. Max pain for everyone. You have right now people who are overly bearish, who think that out of a capitulation, we're going to go straight up, massive rally in the markets, and it'll be up and forever. And those are people who didn't get to participate in the V recovery off of March 2020, and they really wish they did. And they're looking for that type of of thing to play out. And then you have the other people who think that, well, we're very close to bottoming. We're going to see a risk rally, and that risk rally probably takes us to new all-time highs. And then there, the bottom falls out and we crash and we burn. Both of those views are very similar. They're really essentially the same thing, just on the opposite sides. Max pain, I think, for the market would be because no one, including myself, expects that it will happen. I don't want to say no one. There's probably a couple of people out there, but that actually the markets continue. The markets get through this patch that we're currently in. Equity markets, risk markets make new all-time highs and then continue to climb and climb and climb and climb. People will get destroyed. People will get destroyed. And if what I was trying to get at had to do with the housing market, and what I meant to say was that right now, as it is, you have a lot of people trying to sell their houses. There's a lot more inventory on the market that there's been over the last 6 months. Only there's not buyers because it's too expensive for buyers to get into these properties that they had their eye on and looking at. Now, there's a whole segment of the population, and even on high-end properties, that are cash buyers. So it's irrelevant when you start seeing or talking about they can't get into properties because of the higher cost of a mortgage. They're cash buyers. They could still get into properties. It's not a problem. So I imagine on the higher end of the market, you might actually see a lot more sales happening at lower prices. The middle part of the market, I expect for a while, is going to become a little bit stagnant unless you start seeing lots of defaults. It's possible that there are a bunch of people who have variable interest rate loans, mortgages, and they're not going to be able to make those payments any longer. It is possible that we move into a recession and or a greater recession, or as Jamie Dimon says, something a lot worse. And then it is possible that a lot of people are not able to meet their fixed rate mortgage obligations. And then we start seeing a lot more inventory come on the market. And then, of course, you're looking at eventually those rates being cut down and probably cut down to zero. Now, the timing on that, I don't know. It looks like some point in 2023, we start seeing rate cuts. It could be closer to 2024. And by the time we get to zero, it depends on how long this economy runs. At that point in time, there will be a lot more people that will be able to step in and buy. That's my view as someone who has no, let's say, close relationship to following the real estate market and from afar. Boom, 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 boom. Luke, I've seen you often tweet this, so I just want to go ahead and highlight this and share your opinion. Hold on to your homes, hold on to your milkshakes. Not financial advice. There's not enough houses for the population. Labor shortages to build new ones. Rate percentage change and price change will wash out and find a new equilibrium. The new dollar highs. Boom, 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 boom. Dollar down and stocks down together, and crypto holding in. Look at that beautiful 1 hour candle over there. Does Bitcoin continue? No, there we go. Now it's coming off and coming off well. Bitcoin and Ethereum now bleeding out. And that brings us here to our current holdings. The Bitcoin short side got stopped out. As we were talking about yesterday during the live stream over here, expectations were that was going to tag a stop. And it got stopped out on the buy side, and then it gets stopped out on the short side. But the Ethereum trade continues to run into profit, going on, I don't know, like 16, 17 days now, holding a healthy 12.4% open profit. And that is the beautiful dance. And I look at that as on both sides, on them hedging each other. I remember as we ran up over here, let me zoom out just a little bit. As we ran up over here and Ethereum took this buy entry, at the time, Bitcoin was in a short position, right? And while they were both barely into profit, Ethereum flipped first and went long. Why Bitcoin was still short. So in a sense, at that point, what it did was lock in some profit on that side. You got to trade them together. I really, really, really firmly believe that. And I call it the beautiful dance. And the beautiful dance here continues. CTM is running naked now on Bitcoin. There's no re-entry on the short side, not until everything resets here. The only position left to run now is on Ethereum side. I was looking here yesterday, spending some time talking about the dollar strength in 2022. We're looking at it here from, let me try to line this up correctly. Let me start at the beginning of 2022, and it's arbitrary, but I'm just talking about from when we started seeing, well, from the new year. I could also line this up from March, right? That's when the US started raising rates. That might be a little bit more signal, but not really. And just a couple of observations here. We are seeing the Canadian dollar, right? And we're seeing the Swiss franc relatively compared to the other, those that make up the DXY, performing the best. Now, Canadians, Canada is a energy rich country, commodity rich country. I do believe that's the difference that we're seeing over here. And Swiss franc, the Swiss have been very tightening their in step. I'm sorry about the falling off of the flow over there. Swiss central bank has been tightening, right? And they're tightening to a greater degree than we're seeing, like ECB finally getting off out of negative, like Bank of Japan, just absolute continued easing, running curve control. So that's the difference over there. But I just wanted to also point out, I think it's very appropriate to look at not only those currencies, but look at two currencies that are outperforming the dollar. And that is looking at the Mexican peso and the Brazilian real. Again, both of these countries are commodity rich. Mexico, energy independent. And you're seeing why, like, the quote unquote dollar milkshake is taking effect. It's not really true. We're not seeing any dollar shortages. We're not seeing like the slurping up. What we're seeing is, I believe, central banks with severely divergent monetary policies continue to have very low interest rates and or running some type of yield control. And then we're seeing other countries. Mexico has a higher interest rate than the United States. They also have their energy independence. And you can see that the dollar is not gaining on the Mexican peso at all. And that's very different than what you saw back during the dollar milkshake taking place, as we looked at that yesterday. So I don't have to talk about that, as the peso was obliterated, right? You could see both the Brazilian real and the Mexican peso obliterated during the dollar shortages. Not the case right now, and just worthy of bringing up into the conversation as we all get sucked into whatever the favorite narrative of the day is. So when risk on appears, does the peso and Brazilian real go down against the dollar? Let me just pull up really quick the Mexican peso. I'm so familiar with it, and I remember a lot watching that throughout 2020, 2021. Let me just pull that up. And then, so peso was appreciating during this whole risk on move. Peso was appreciating during the whole risk on move. So I don't think it's, so yeah, so it's just not that easy. And the peso really, surprisingly, has been able to hold on to massive gains. I would say gains. It's flat really against the dollar. There was a period of time when it was making gains during this area over here, but the peso throughout the strengthening of the dollar remains just very strong. Remember, this is where the dollar bottomed, right? The DXY. Let me pull it up. We could say right over there into July, right? January to July of 2021, January to July of 2021. This is where the dollar bottomed. And then here's the dollar actually making a little bit of a stride against the peso. It was really like a fake breakout. Here's one, right? And then two. There's the breakout over there, and it didn't really go anywhere. So sideways, interesting to note. I'd like to think of this as truly a lot more, let's say, supportive of Zoltan's New Bretton Woods, where we're seeing actually commodity currencies play a bigger role, a different role. But again, it is a new paradigm, and I think that we need to just be open, and that's the best way forward, being open to everything. Vincent, S&P was in a 10-year channel post 2008 crash that was tested and broken March 2020. We're not back in that channel, possibly headed towards the bottom of it over the coming months. We got to get back in our channels. I wonder if I pull up Vincent, if I still have it. I don't have it. I would love to get a look at that, Vincent, and line it up and take a clean look at it. I don't have it. I would like to kind of move a little forward over here. And before we do, let me check out yields. Yields were spiking up this morning, right? Prior to the jobless numbers. There was also a gap up at the same time right there after that, the hour offline. I don't know what that was for, why that happened. And we're just seeing it going nowhere after the super sharp move down. So we've remained kind of in no man's land. I think that tomorrow's GBT, third quarter, Atlanta Fed's final expectations should give the market a little bit of a push one way or the other. Dollar now coming off. Interesting, as we're seeing crypto and equity markets also getting thrashed out there. I kind of wanted to make this, even though it's not Friday, but it is our last session. And I wanted to kind of, again, reeling off the comments that yesterday shared, I wanted to open this up and see if we wanted to do a little bit of any type of freestyle question and answer. Take a look at anything specific today. I'd be happy to do it. Also enjoyed in the comments someone mentioning that they really liked when I showed yesterday the video at the same time, or the camera at the same time. And I remember during yesterday's live stream, there was a part of the live stream where I was talking about something. And when I do that, it's funny. Like sometimes when I'm talking with you, I'll close my eyes, almost like have them shut, and like really get into those thoughts with you. And I was thinking, wow, if that was on video, that would look quite ridiculous. But nevertheless, it's all in good fun. If anyone has anything that they would like to get into or talk about, let's go ahead and do it now. And then until then, I'm just going to keep looking around and see what's going on, right? Gold was spiking yesterday, quite volatile. Did you see that it came right into that resistance? Horizontal resistance. Silver, look at that. Right into our resistance over there and rejected by it. A break above or back above this, I think, just takes us back into no man's land with that really important resistance that we were talking about yesterday, that trend line resistance, waiting for a break above if we're going to take any type of poke on the long side. This really looks like a big pendant forming. I think it might make it a little bit easier if you're looking for any further downside continuation. Now, you are into resistance and being rejected by resistance over here. We talked about yesterday why the correct trade should have been over up here off of this resistance, why this line should have been here, and why that would have been a better entry. And at this point in time, you should be locking in profit. But if you are, let's say, small time frame minded, not time frame, as far as trade duration, you are being rejected off resistance right now. It is a decent risk reward into the next area of support, in so much that your stop would be right around here, whether you chose to be above here or over here, right? Entry occurring right over here. It is greater than a one-to-one risk reward just into the target area, the target of support. And of course, you would be looking just at that point to move your stop loss to break even. I'm also noticing at this point, I'm just going to clone that really quick and then bring this down. So it's still greater than a 1-to-1 into that first area. On a test of the upper channel right over here, I would be looking to go ahead and tidy that trade up, be very defensive, move the stop loss to break even, and then see. If this does fall out, though, this could open up some massive, massive downside. Look, if that's breaking down, obviously we see that the equity markets are teetering, right, from what looks like the edge. And it would not be surprising to see them fall off the edge. Same thing with Bitcoin. We just looked at earlier in the session how it was just simply going sideways from the June low. And the longer it goes sideways, the longer and the more and more jeopardy it would be of breaking down and falling down. What would offer the greatest, let's say, alpha to the downside? Well, that's another question that you have to be thinking about. But here, or the markets looked and continue to look a little bit, let's say, suspect right here, right now. Vincent, I'm interested. I just can't see it. Right, Brent. I'm not familiar with those instruments, TCF or CSE. I'm not familiar with what those are. Are those altcoins or what are they? Yeah, I don't have a link in my comments. You can see the link in yours. I'm gonna check it out, Vincent's. Or Vincent's, I could go back actually, if not, into the live stream afterwards, and I could go ahead and take. Yeah, I don't have the link. You might see it on your side, but YouTube doesn't allow sharing of links inside the live streams. I don't see it. I don't see it. All right, let's see TCF. I'm going to start. By the way, you see, I'm not familiar with this all. Not something I've ever pulled up. The first thing I did was pull up a 3-day chart. Coming in blind, Brent, in so much as I'm not familiar what this is, what type of energy company it is, or anything like that. What the energy sector it is, whether or not they're focused on Canadian light sweet crude, or if they're focused in on natural gas. So I have no idea. And, you know, let's say right now it's in a massive uptrend. It's continued to consolidate towards the top of the uptrend. I don't see any type of potential breakdown looking to be. Well, that right there is a little one, right? So now you see what looks like a bull flag developing, a healthy correction. What about support and where I found support? Right over there, right? You can see very clearly coming off the ledge over there, finding horizontal support there and there. A breakdown below, right? Where's the next area of support? You can see where my mouse is. I'll draw it very clean and pretty. And so the thing about TA is what TA does is not try to, and in any way, shape, or form, predict what is going to happen next. What TA does is give you levels that you're able to manage your risk around. Your risk is whatever your position is, whether it's completely out of the market or you're in the market, whether you're in a current position into profit. You're able then to manage your risk around certain levels, rather than try to predict what is going to happen. Now, if you're not in this trade at all and you see that you're sitting over here on support, what are you trying to do next? Are you trying to get into a trade? And it looks like that you're potentially getting a higher high on the daily off support. And that alone, I don't think you need the sloping down trend line over there. But even a higher high over here off support, that could be a trigger sending you into the trade. Now, what would your stop be? Obviously, right below today's low of today's candle, if that trade did indeed trigger. From in my opinion, this way I would do it or manage it. And it's a good trade in so much that your risk to reward is incredible. And by the way, whatever you're risking on that trade, like if you are taking the entry over here and you're putting your stop loss over here, that's how you're whatever you're willing to risk on that trade. If it's 1% of the capital you're putting at risk, that's how you position your size of this trade, right? Now, the risk to reward, what would you be targeting on a trade like that, right? Probably somewhere in this area over here between 0.445 and 0.45. Around that area, that would be the first target. So your risk to reward is pretty phenomenal on that trade. Now, I'm trying to look for the next thing I'm looking at, being that this is something that's publicly traded, is gaps, and to seeing that if it has any characteristics of being gappy, because unfortunately it doesn't trade 24 hours a day. I prefer instruments that trade around the clock so you could get out at any point in time if you do need to. Things happen. you could, for example, it wouldn't be surprised if we saw, you know what, I don't even want to say the words, but everyone could imagine the worst case scenario that has been threatened right now on the battlefield. And if you were to see like that, markets closed overnight, where does this thing opened up? That it's why I don't particularly like the public markets, but it doesn't look like it has. Or earlier on, Dan, I guess when it was to see I'm just looking at the gaps, but I imagine the volume was very light over there. I have no idea you can see we're growing now in volume now. It's a little bit more liquid, but it's something that I would stay away from. I deem it to be extremely high risk for those reasons I just described. So that's my opinion on it. All right. And then CSC. Let's take a look. This is not enough. Is that what you're looking at over there? There you go. I assume this is what you're looking at, right? Over in Canada. And I mean, like all you could say, or all as I could say, is late to the party, or I would be late to the party. And extraordinarily strong downtrend, looking to sell off resistance, right? Conquering the markets all day long. That was the last opportunity. You could see into this bit of supply over here. This is where you found resistance. That was the last trigger, right? And that happened all the way down, right? You could see it down over here. And so right now you're just late, or there's no opportunity, right? Every time this comes back into any type of supply, it's being sold. Here's a horizontal waterfall, right? Again, that's what we're worried about right now in Bitcoin, is just that sideways, boom. And this could happen, by the way, if that does happen on Bitcoin. A lot of people think that because of what happened in 2018 after going sideways and falling off a cliff, and then all of a sudden it bottomed, you could see that happen. You could see price come back down and keep making lower lows. But over here, late to the party, or I'm late to the party. That's all. Initial joblets came out, plunges to new 5-month lows. That's bad news because it means Powell's tightening isn't working. That's right, Cloud. That's how we started this stream off. Nice way to summarize it. Powell's tightening isn't working, or it isn't effective, right? To slow down the economy, expect more hikes until something breaks. I think yesterday was a very important piece of the puzzle. And all is that it says is that, you know what, as things get sketchy, what are the central banks going to do? They're going to come back in and flood the system. It's all they could do. So, I mean, I don't know if that should make you feel better. It makes the problems much worse down the line. However, we've gotten to a point now that if they were to pull away liquidity and they weren't be there to backstop it, we are looking at, Armageddon. So I don't even want to get there. Definitely. Thanks for bringing that up. It's fun to not only look at charts, I think it's really fun to show the thought process behind looking at a new instrument, especially one that I've never seen before, and how I would just view it. And it's a good exercise for everyone. Most of my friends, we are in one sub 30 demographic. Corey, I haven't. And the only reason that I haven't is because of, I'm not saying that there's any type of correlate. I mean, whether there is or there isn't, I do not know. But you asked me if I've looked into it, and I haven't. I remember that the dollar vigilante, his name escapes me right now. But either which way, dollar vigilante, and I remember, I forget what year it was, but it was some type of Shamantai cycle, and like the dollar was going to collapse, and and all that stuff, and it never happened, right? And a lot of people like to remember when things do happen and when things are correct, but they're both just as important. And by the way, that doesn't mean that you shouldn't pay attention to. Does anyone have his name? Not Brent Johnson. Does anyone have the name of the dollar? Jeff Berwick. Yeah, and you know what? Like Jeff has a lot of actually good thoughts. For some people, they might be a little bit too, let's say they're just not ready for them. But I have to say, I don't want to be controversial, not because I don't want to be controversial, only because I don't have any type of like invested interest in this topic to be controversial about. But the way that from the very beginning and throughout the pandemic, as Jeff would refer to it, he was very spot on about a lot of things, and he has a long history of being very spot on about a lot of things. Now, his timing, just like his mentor, who's his mentor? Casey something, the guy that has the compound in Chile because he's waiting ever since the last 30 years for the dollar collapse. I mean, lots of really good thoughts, lots of stuff that you can learn from, and highly recommend, even as a vantage point, if you have the maturity to be able to listen to topics that you might find, let's say, just not sit well with you. Like if you're able to be emotionally detached and listen to other people's thoughts, it's a good vantage point. I don't know how much time you want to spend with it, but in this case, you know what? It hasn't played out in the past as per expected. It's not something that I personally spend my time on. It could be correct, and if the world crashes right now and things break, they're going to be like, look, this was the seventh year. But just a couple of years ago was a different year of the site, and it didn't work out. And that's just my own thoughts. Yeah, great to see you here in here. CTM strong all day long. Yeah, I'm not going to uh between 2015, right? Somewhere around 2018. It was either 2008, I think it was 2018. It could be 2019. Jeff was looking at another Shimata cycle. Maybe it was a 74-year Shimata cycle, and the world was supposed to end, and the dollar was supposed to collapse, and it didn't happen. Let's say it's just not something that I spend my time with, but I like Jeff. As long as you're able to view that from a detached view, there's good stuff. Doug Casey, right? Doug Casey, his mentor, also has a long history of just being on the wrong side. But a lot of people are drawn to that type of analysis. A lot of people don't like today what I would refer to as sincere analysts. I have no idea what's going to happen next. I cannot make any type of prediction of where the market is going to be 3 months from now. These are a data dependent market that requires a lot of work. A lot of people would like to hold on to like something that is easy and takes out all of the work. The markets are going to go straight up from here and make a new all-time high and then crash. Oh, I love that. So I'm going to lean in, and then as the markets go to the new all-time high, I'm going to sell everything before they crash. Or the markets are going to crash and you're going to be able to buy Bitcoin at 3K. Ooh, I like that idea. I could just continue waiting on the sidelines, watching my money, be evaporated by inflation at a rate of realistically and probably the official rate is right now 8.3% year over year, right? Take that with a grain of salt or for what it's worth. And, and then if that happens, I'm going to buy it. And then they say that Bitcoin's going to moon, and then I'm going to be all right. Those are very like easy things to embrace because they allow you to dream the whole way. But I can't do that. I don't think either one of those things is going to happen. Or if you do believe what Stanley says, that, well, probably there's a good chance, obviously he has no crystal ball, that the markets could go sideways for the next 10 years. Now, if the markets go sideways for the next 10 years, they're not going to go like Bitcoin's going right now, and that's literally just sideways. There's going to be some nice movements in there. I don't think that we're looking at this range over here, this $7,000 range, to continue. But the markets have been going sideways here for 18 months. If you go back to where we were 18 months ago, we're at the same price. By the way, it's quite interesting if you see that horizontal line down there and you could see that line that we're barely above. That line over there is actually, well, if you're open to thinking about things a little bit, let's say flexible, that is the previous cycle all-time high, in so much as that it's the structure the market formed. What do I mean by that? Well, we see the test of it over here in June. That's very clear, right? We see over here prior to the bull market breakout over here, the leg up where we took out the all-time highs. You see that that is clearly where we were able to establish some support, and it was shaky, right? You could see going down. Let me zoom in really quick. As we went below it, right, you could see that it was resistance. We got back above it, confirmed into support again. And this is where you could say that truly this is how it happened and what happened. If you come back over here to the previous all-time high, I could say that, well, there were about 2.5 days we traded above there. I don't know how much volume actually changed hands up there. But you could say that prior to that, that was resistance, 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 resistance. That line to me is the market actually paying a lot closer attention to a level than just looking at the previous cycle all-time high from just, I mean, truly, that was the previous cycle all-time high, right? 19,790. But you could see that the market was giving greater precedent, more, I don't know the words, but you know what I'm talking about. If you have them, you can type them for me, please. But you could see that, we are sitting right above that line, and that structurally, I'll call it, is the previous cycle all-time high. We're in jeopardy here of falling below that, and then things could get pretty nasty, I assume. Boom, 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 boom. I heard that previous dips in Bitcoin, 83, 90%. So yeah, 83, 90%. But that was during the hype cycle. You were looking at a much thinly traded market. Bitcoin right now is traded on, really so many exchanges throughout the world, including on the CME. It's a bigger, much bigger market than when it was. The last two have obviously retraced 85 and 84% respectively. And a lot of people then like to say that, well, then means that this one is going to retrace, and we'll be looking at it retracing 85%. And if it does, we're looking at right over here where this line is. And I just don't know how accurate that is. So let me just make sure as I wish to be. All right, 69. Let's just bring that up a tiny smidge. All right. And, but what's to say? What's this? And if you're looking at the previous two cycles before us, this one retraced 85%, this one 84%. And it is possible this one retraces down to here. But just because the previous two did means nothing, honestly. And the one prior to that, it was really a very immature market with a very small market cap and traded on very few exchanges. So, I wouldn't put too much credence into that, but I should say that it is possible that Bitcoin comes off 90%. If it comes off 85%, depending on what the macro is, a lot of people like to say Bitcoin's never been through a tightening cycle before. Well, it surely has. It was going through a tightening cycle right here as the Fed was raising rates and the Fed was doing quantitative tightening. So it's been through a tightening cycle before. It's going through one now, but we don't know whether or not Powell, who hasn't been so successful up until now, we do know that these rate hikes have a lagging effect. And if the Fed goes too far and then things really break and even break beyond, their ability to, let's say, correct them in a timely manner, then we could be seeing a lot lower for a lot longer. That's entirely possible. And it doesn't mean that's what's going to happen. We could see, for example, anything like something happening yesterday, just completely out of nowhere, trigger a risk rally. including maybe tomorrow's GDP print. It could be anything. I don't know what it is or if that's going to happen. I just don't think that you could be very holding one view so firmly one way or the other. And if you're holding that view that right now, since the markets are the Fed is intent on tightening until something breaks, well, first of all, it might take a lot longer to break than you think. And you could see now rate cut expectations keep being moved out further and further to 2023, which means that the economy is going to be running stronger and stronger for longer than expected. Now, generally what happens in the past when the Fed is tightening, they're tightening into a strong economy. One could make the case that the economy is strong, but it appears weak. We have literally 2 quarters of negative GDP growth. And when the Fed is tightening into a slowing economy, rallies do not rally back to make new all-time highs. Now, if we do see some type of growth returning over, again, we have this current quarter into the end of the year, and it turns out that the Fed continues to tighten, and truly indeed, it's not tightening into a slowing economy. We looked at PMIs that just came out last week, and they surprised to the upside. It was a surprise, and again, it was showing the economy. It is possible that the market is able, if it turns out the economy is indeed not slowing down, it could then rally, right? Now, I guess you could tell that I give that a lower probability, but we don't know until tomorrow what the GDP estimates are, and then we don't know what the ones are after that. And unfortunately, it just means we're data dependent. But if you take the posture or the belief that what we're looking at is that the Fed is tightening into a slowing economy, and that just means that things are going to break, well, you can't also say then that I think that Bitcoin is going down 85%, or what is it, to 3,000? There's lots of calls for $3,000 Bitcoin. Is that a 95% correction? A 95% correction. Look, why it could happen if we are in like massive amount of people losing jobs, people getting kicked out of their homes, companies aren't hiring, inflation's running above 10%, and it's just nasty out there. But if all that is happening and things are indeed going from bad to worse, we saw yesterday that what we're going to see is, regardless of what the posture was the day before, and out of the Bank of England, it was we're tightening. All of a sudden, you're going to see quick pivots. So whether it's very hard to time. That's all. What? Long-term holder supply is all time. I mean, and Fabio, I personally believe, this is my own thoughts, whether it's true or not, I believe that there are a lot of people that were forced to sell, right? And we saw that, whether it was Luna, right? Luna forced selling. Then 3 Hours Capital, because of that forced selling over here, got wrecked, and that also forced Celsius over here to sell, including some Canadian pension funds. Everyone over here, forced selling occurring, and the people that are holding, where you look at the army of plebs that are holding, even if Bitcoin goes down 95% or more, like, they're not selling. And literally, now, of course, there will be a certain cohort in there that has no choice but to sell, but the rest are not selling, right? And a lot, or I should say, a large portion of that, not only are they not selling, we would be buying if you saw Bitcoin sub 10K. And then if Bitcoin went down sub 5K, like, we would be buying. And those hands are really strong hands, meaning they're not selling, right? And they are called and deemed by Trace Mayer the hodlers of last resort. And it's a real thing. I count myself among them. I know that, I'm not selling, like, there, and I'm not alone, right? So that offers a different type of dynamic. At what point in time do other people, speaking of Stanley Druckenmiller, the whole reason that he bought into Bitcoin 2021 was because he saw after the crash of 2020 that the amount of people looking at the 1 year hodler ratio, right? We have it over here. We were looking at it yesterday. He saw no, I'm not logged in, unfortunately. Maybe I can just go back one and pull it up. He saw over here as the market crashed that over 58% of the people on the network continued to hold. And then that started rising. And he said, wow, that's something that I want to be a part of. If you start seeing Bitcoin crashing down again and you start seeing a bunch of people continuing to hold, there are smart, astute investors who are going to take notice, right? And as the lower the price goes, the amount of money it takes to have a significant effect in the price rise of Bitcoin is highly correlated. Boom, 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 boom. Could price collapse to meet the bull market's breakout line? What's a chart we could look at to take a look at that? So we have to look at it in two ways. This is on log scale, right? And then we'll look at it on linear. I'm just going to extend that down over to there. And yeah, I mean, for sure. Or maybe what you're asking is that something that if we were, Mark, to see actually things breaking down and breaking down sharply, like, past $9,000, right? Right there. Past $9,800. At that point, probably seeing a fast acceleration. Would that be a good place to look at and lean in? That's some pretty good awareness over there. Let's look at that on linear as well and just get a look. And I don't have it here, so I'm going to draw it here. And that one, no. So on a log scale, of course, and everyone knows, and I just want to affirm one more time that I am a big believer on log scale for the important technical breakouts and repairs on Bitcoin as being much more signal than on linear. I consult them both when looking in the near term, and I think it's important to consult them both. But if you have to ask me if I have one that I gave priority over, is going to be on the log. And you could see why I did it on linear at the time, right? And let me just jump over to linear just for a second. I just want to get a view myself. See, that's a tough one. And that's why I'm saying I do like linear here is how I did it in real time. Let me zoom over here. Linear is how I did it on real time. And by the way, this got a lot of the internet really into the trade at the right time. Everyone following CTM at the time. And that's when it was not like in flavor, right? That's when not people were really paying that much attention to it. And this is a clean breakout. And it really was helpful. But in looking at it and viewing it, and this is why I was able to do it, right, off of that June 2019, that 4X off of the low, why quantitative tightening is happening. But off of the log, it actually, I think, was more correct, if that's a word, more correct. And how does that work? Well, it doesn't, Jordan. Let me go ahead and tidy that up off the June high over there, right? Oh, sorry. You got to come back on log to do that, right? So that is tough, right? So if you're doing this on log in real time, and again, I'm telling you a couple of things here. The first I'm telling you is nothing is clean cut and clear. And when you start seeing people who think that everything is so straight and narrow and that's a red flag. It's not like that. It takes a lot of balance, and it takes a lot of flexibility, and including looking at, for example, the reason why I look at linear and log and at the same time is to get just a different vantage point. And if you were doing this off of log in real time, right? Let me come to a 3-day chart. It might be a little bit easier. Why would you not pick the top of that, right? Like that. I think that's what you would do, or I would do. And then if that happens, you could see, breakout, retest. But that looks like a breakdown. That's okay. Even if you were just doing it like that, that would mean you'd have to get out and get safe. right? And then you have an opportunity to get back in over here after the retest on the resumption up. But in hindsight, and it's off of not that wick over here, and you can see it clearly on the daily. Not the wick, but after price came back up, and then that's where it started confirming the resistance, and then another test over there. And in hindsight, adding that line, I could then say, oh, and that's where it found support. But in real time, that's very difficult to do. It's very difficult to do in real time, but the line stands like that because it's correct. In real time, I was doing it on linear. It provided a really good platform to do it off of, but I think log is better, and doing log in real time would have been very tricky. And it's just pointing to, again, just it should be down a tiny bit, right? So I'm touching those lines, touching that line, right? Almost touching that line and then finding support. But that's why when you see on the DXY today, when I'm looking at that and I'm like jumping back over to here and I'm looking what the market's paying attention to, because just because I had this one line in over here off of that like 2 seconds that we took in the live stream 4 days earlier when I just cloned those trend lines, well, that was a good guide, but the market was showing me where it was paying attention to, and that's what we want to do, is we want to be flexible to the market. All right, everyone. Any thoughts on GBTC long term? I don't have any thoughts on GBTC long term. I saw yesterday that Dylan put out a thread sharing thoughts on GBTC. So I imagine his thoughts and then the comments of that would have is a good resource to point you towards. And that's all I want to do, is I want to point you towards the best resource. That would be a good place to pick up on that conversation. But I don't know what happens. I mean, obviously the fact that a spot ETF has not been approved is completely suspect. And what happens going forward, I have no idea. I don't know at all. I do know, and with the greatest and utmost, let me try to pull it up. GBTC, right? I do know that, CTM, GBTC is probably the only way that I would recommend going about it. And you could see since the top, November, sidelines, one opportunity and attempt in April that was quickly released on the sidelines and continue to be on the sidelines. If you were trading a 401k and you have your money just continually getting plummeted, it's not a good position to be in. And even if you're not participating, right, this is just being sidelined here for 11 months straight with one trade over here. It's a lot better preserving that capital and keeping it ready for when the market does resume out, to being able to, with all of that capital on the sidelines, just getting a much lower entry into it and back into it at the right time. I mean, for that alone, the course, the training program, working with me is entirely worth it, and is not even comparable. But this is, I would say, one of the least things that we do, and it is. And I don't really, anyway. If you're interested in working with myself and my team, the link is below, and the work we do is, I would say, amongst the best in the space, like unparalleled. But anyway, you bring up GBTC, and I don't have any thoughts on it, except that probably, rather than having thoughts or ideas, the best way to go about it is to trade. I'll try to see if I could get my old crystal ball. It would be nice to have some idea of knowing what is going to happen next. And I think that it might be underrated to talk about the ability to pick up that posture. And so quickly, it was really, we became data dependent, I think, in between the period of late May to mid-June. And I think that's when we started talking about the macro could change rapidly. And at that point, and for a brief period of time, the macro did change rapidly. And then why it was changing rapidly, we talked about that it could change again. And then we saw that September CPI, which was a game changer in many ways, showing that except for energy, everything else was continuing to rise. That's the world we live in right now. That's the best way to approach the markets. It's difficult. It's not easy, but there's nothing easy about it. And we will get to a time when things are let's say easy again. And don't forget, even when things are easy, most got it wrong. If you talk about the bottoming in 2020 into the spring of 2020, and you go back and you look at Real Vision and you look at what their posts are, they were expecting up through 2020 for the markets to crash in an insolvency event. Those same people out there today, people take out their word for what's going to happen next. Got to be careful. It's very difficult. That's where we'll leave it at. All right, everyone. Thanks for being here today. I'm going to miss you for sure over the weekend. I won't be here tomorrow. Won't be here on Monday. We'll be back at it Tuesday, and then we'll keep going. Everyone, have a beautiful day. I'll talk to you soon. We didn't make it to 100 likes. We do have 200 people in here live. So why that is quite significant. There we go. Oh no, we're too short. If someone on their way out could go ahead. Oh, thank you so much. Thank you for that, Dave. Thank you so much. And everyone, God bless you. Yeah, of course we got CTM. And tomorrow morning as well. Ace. We're on in just a little bit, and then we're on tomorrow morning as well before we take off for Mexico. Zam, thank you for making it happen here today. Replay crew, big shout out. All of you, lots of love. I'll see you again on Tuesday, and we'll be there strong. Have a great day, everyone. I will talk to you soon. Brian, thank you. Thanks to everyone. Really grateful to be here with you all. Thank you. Much love. Oh, yeah, that's a great. This is a great suggestion. Looking into Bitcoin miners versus ETS as a proxy to Bitcoin. I was thinking you were getting into, though, by the way, as the miners showed the collapse, I would say the pre-collapse that was coming into the crypto market. It is something that should potentially be looked at as when we're seeing a recovery coming into the markets as well. But whether or not you're looking at instead of GBTC, whether you're looking at miners and or MicroStrategy or what have you, I think there are lots of options out there. And I'm I guess you can't. I'm a trader, and the futures are a great place as well to trade, but you wouldn't want to be, I don't think, holding on to a position. Anyway, we'll talk about it later. Thanks, Mark. Appreciate that very much. Have a beautiful day, everyone.